Morning, everybody. From a sunny but chilly Cape Town. We're in our office here in Newlands, which is in the Great Westerford building, just opposite the old Newlands Rugby Stadium. Today we're talking tax. This is such an important subject for investments and your retirement. It's amazing how many basic savings you really can have and what a difference it really can make to your returns over time. So this is a great webinar that we're putting together. I'm Nick Brummer, a director, and joining me is Stuart Dyer, my fellow director. Just a little bit Investonline. Investonline's financial planning and investment advisory business. We have a team of 15, 10 professionals, 5 CFPs, certified financial planners. I'm a chartered accountant, and then 5 admin support staff. We registered with the FSCA, and we're doing a series of these webinars where we've got just given a lot of important information. I really urge you to stick it through. There's some really good content, and I really think it's going to add a lot of value to you. Stu's going to be doing the presenting. I'm going to chip in here and there, and then we'll have some questions afterwards. We've had quite a few questions submitted. Right, thanks for joining us. Stuart, you ready to go?
Hello, good morning, everybody. Thank you, Nick. Thank you to everybody for joining us today. Let's get the slides back up here. Okay, so this is the content we're going to be covering today. Quite a lot of good information to work through. So we'll start with an overview of investment taxation and just go through some of the key theory around investments and the applicable tax around that. We'll talk about the tax-efficient investment vehicles and ones that we commonly see and what are the tax benefits of those vehicles. We've created, I think, 4 or 5 really good real-world scenarios. So situations and cases that we see day to day and different structures that can be put in place and strategies that can be followed to be tax efficient. We'll discuss offshore investments and a little bit around the taxation on that. And finally, we'll end with immigration and tax implications. Nick, I know we don't have a live Q&A, but we have had a large amount of questions submitted, so we'll answer some questions live. And we'll obviously get back to all the audience members that submitted questions. We'll get back to you with your personalized answers as well. Good. So just to start off with, in terms of taxation, so in the South African system, you essentially have 2 methods of being taxed. Your first method is in the left-hand side of the screen is your taxation that is automatically taxed or income that is automatically taxed. Normally that's done through pay as you earn. So that's when I'm just getting a message here. Sorry, I've had the wrong microphone on. Does that sound better, Nick? Okay. So on the left-hand side, the income there that gets taxed as pay as you earn. So that goes through a payroll. So income such as salary, bonuses, commission, annuity income, leave pay, that all goes through payroll and automatically taxes deducted and paid to SARS. And on the right-hand side, what we consider self-declared income. So that is income that you earn outside of your ordinary work or outside of your pension. So interest income, rental income, if you're a beneficiary of a trust and you get trust income, capital gains you have to include in your tax return, as well as foreign dividends. So those different sources of income, you put that into your tax return. SARS knows how much of those different sources of income to tax, and that can result in additional payments that need to be paid into SARS over and above the pay-as-you-earn taxation that's already been collected. So that would be done in your tax return. If you're an ordinary taxpayer, you would file an annual tax return. And if you're a provisional taxpayer, you would do tax returns 3 times a year. So just a little bit around the tax table and understanding one's tax rate. We feel this is really important. So as we know, we've got a sliding tax scale. So that means you tax certain percentages on certain rand values of your income. So on your first 200 odd thousand rand, the tax rate's 18%, then it moves up to 27%, etc., up the scale, all the way to the maximum tax rate of 45%, which is above just over 1.8 million. So if you're a top taxpayer, your top marginal tax rate is 45%, but that doesn't mean you pay 45% tax, average tax rate across all of your income. So we've just done some examples. If you earn 500,000 Rand taxable income in a year, your marginal tax rate is 31%. That means any additional income you had to earn, such as interest, that would be taxed at that margin of 31%. But if you had to look at what is your actual average tax rate across your income, it's 200,000 Rand. 20%, which works out to 100,000 Rand. So in this case, you can see 20% your average tax rate. As you go down R1 million, there your marginal tax rate is now 41%, but your effective or average tax rate is 29%. 2 million Rand, it's 45% and 35%. And if you were 5 million Rand annual income earner, you can see you in the 45% margin, but your average tax rate is 41%. So the more money you earn in that top tax bracket, the more your average tax rate gets closer and closer to 45%, which is the top tax bracket. The reason this is important is because it normally investment income, capital gains, different sources of income that you make from your investments is going to be taxed on top of your normal sources of income, rental, interest, if you're still employed and you earn salaries and bonuses. So it's important to understand how the marginal tax works and how the effective tax works so you can plan accordingly. And we're just going to do an example on capital gains tax. This is still an area where we feel investors don't understand the calculation for capital gains tax or don't know how it's practically calculated. So we thought we'd just do a quick example on it. So capital gains tax, I know this is a busy slide with some of the methodology around calculating it. It's essentially a tax that's payable on any profit you make, or what's called a capital gain on an asset. So that could apply to a property you own, a share portfolio, a unit trust fund, any investment where there's a profit in nature that's considered a capital gain, that's not considered an income from a trade or from working. So how it's taxed is that the capital gain is calculated, basically calculating the profit you've made, and then it's a certain inclusion rate is included in your taxable income. So if you're an individual, 40% of your capital gain is included in your taxable income. If you're a company, if you're investing in a company or in a trust, the inclusion rate is double. So 80% of the capital gain is included in the company or trust accounts as taxable income. So what does that calculate to? So that means as individuals, we can pay a maximum capital gains tax of 18%. The range is actually between 7% and 18%, depending where you sit in the marginal tax rates. If you're investing in a company, the effective rate is 21.6%, so it's a little bit higher than individuals. And if you're a trust, it's a lot higher, it's 36%. There are some exemptions and exclusions that are allowed, such as you're allowed a small 40,000 Rand per year capital gain before you have to pay any tax. You're also allowed 2 million Rand capital gain on your primary residence before you pay capital gains tax. Your personal use assets, such as your cars, your personal daily items like furniture and clothing, etc., is not subject to CGT. And you do have a higher exclusion in death. So when you, in the year you pass away and that final tax return is submitted, you're allowed 300,000 Rand in capital gains before taxation is applied. Let's just work through an example together.
So in this example, an investor has sold an investment for 5 million rand. We did calculate the gain by looking at, well, what was the purchase price or the base cost of the investment? So here we say he's invested 4 million rand was his initial investment. So that calculates to a capital gain of 1 million rand. We remove the exclusion that you're allowed of 40,000 rand. It gets a net gain of 960,000 rand. And that's what's then calculated or multiplied by the inclusion rate of 40%. So of the 1 million rand, 384,000 rand is what is actually taxable in the individual's tax return. You times that by their marginal tax rate. In this example, we're using 41% marginal tax rate as an assumption. So the actual taxation, so he's made a 1 million rand profit, and the actual tax he has to pay on that 1 million rand is 157,000 rand. So that works out to an effective CGT rate of 15.7%. So remember, as I said just now, your effective CGT rate will range from 7% all the way up to 18%, depending on your margin. So because this individual is a 41% taxpayer, his effective CGT rate on this transaction was 15.7%. Now we've got a few practical examples just around investments, and what we're gonna do here is we're gonna throw 3 investments, all of 10 million rand over a 5-year period with a return assumption of 10% annualized return. So the only difference between these 3 different investments is that the manner of the growth that you've earned was different from investment to investment. So in this investment scenario on the screen now, we're referring to the investment as earning interest income. So interest income, because interest income is fully taxable, less a small exclusion that you're allowed per year, it's fully taxable in your taxable income. There's no inclusion rate like capital gains. It's generally considered less tax efficient than capital gains assets. So in this example, this individual invests 10 million rand, let's say it's into a fixed deposit, and that 10 million rand is growing year by year by year, earning 10% interest. And at the end of 5 years, the after-tax outcome for the investor would be just above 14 million rand. So if you look at the little red blocks, that is the annual tax expense that would come about as a result of the interest income earned. So as you're earning in the first year, you've made 1 million rand interest. Now that 1 million rand interest is taxable as part of the tax return. So we've estimated the actual taxation caused by that interest would be 282,000 rand. And then you can see in the subsequent years, 311,000, 343, 376, and finally 411,000 rand. Now the key thing with interest income is that it is taxable in the year of assessment that you earn it. So it doesn't matter when you withdraw the interest. It doesn't matter when you spend the interest. If you have earned the interest, you have to pay tax on it in that period of assessment. So in theory, if you're in a fixed deposit and you don't have access to that money, you might have to fund the interest or the taxation out of other savings if you didn't have, if you're not having access to that fixed deposit. So in this example, we can see the outcome is 14 million rand, and the total tax across the 5 years, we work out to be just above 1.7 million rand. So that's quite a large amount of tax. If you see that you've essentially made 4 million rand that you've kept and 1.7 million rand you've paid over to SARS for taxation. And we look at another example, and all the assumptions are exactly the same. 5-year period, 10% annualized return. And the only difference is the fact that this investment now is earning capital gains. So this could potentially be a share portfolio or a unit trust that invests into shares. And now you're making a return, but that return is considered capital gain or capital growth and not interest income. So the key thing with capital gains tax is that tax is deferred until the end of the transaction. Because when you buy a house or you buy an investment, the market value of that investment changes all the time. In the case of unit trust, the market value changes every day. It's difficult for SARS to say what profit or loss to tax you on, so they only do that when you actually dispose of the asset. So in this case, this person would have invested 10 million rand. That 10 million rand earning 10% per year for 5 years would have grown to about 16 million rand. And then what we've said, if you calculate the capital gains tax using the method we showed just now, the capital gains tax would be about 900,000 rand that you would have to pay over to SARS. That capital gains tax would be paid actually in the following tax return, normally the end of the year, as a payment that would have to be made over to SARS. So from 14 million rand in the previous example, the same return, now you're getting 15.2 million rand as a net outcome. So a considerably better outcome. Now we understand not everybody likes to invest into, let's say, more growth-orientated investments such as shares. So now we've done an example on a blended option. If you had to invest in, say, a more balanced unit trust fund, or even if you had to have an investment property where there's a combination of capital gain and a combination of income from rental income. So in this example, you're earning some interest and you're earning some capital gain. We've assumed 50-50. So half of your return is considered interest and half of your return is considered a capital gain. As you can see, there's small tax payments due in the first 4 years for some of the interest earned. And then at the final year, there's an additional payment for capital gains. But the outcome of this investment is still sitting at 14.86 million. So still quite a lot higher than the interest-only example where the outcome was 14 million rand. And a lot of the reason for that is that some of that tax is deferred into the end. So the more money you can keep in the investment for longer, the more that capital can grow. So we'll just look, and on this example, the total tax is around 1.1 billion. So if we just look at the three different types of growth side by side, with the interest only, you would have made an after-tax return of 7% per annum. So a 10% growth, gross income is now reduced to 7% net income. So that's quite a haircut for taxation. If you look at the blended option, 8.3% per annum, so a better after-tax outcome. And the capital gains only option, you would have made 8.8% after tax. So a much better outcome after tax. Okay, so now we're going to talk about a few tax efficient vehicles. We've just hand selected a few that we're going to go through. So I think everybody at this stage knows about a tax-free investment account. Tax-free investment account was introduced maybe 7 or 8 years ago, and it was really to encourage South Africans to save more. So outside of your normal retirement investments, they've introduced a tax-free savings or tax-free investment account, and they really are a really good investment vehicle. So it's very flexible. You can buy unit trusts in tax-free investments. You can buy ETFs. You can open a savings account at the bank. The main con of the tax-free investment account is how little you're able to contribute. So you can only do 36,000 Rand per year, or if you want to do a monthly contribution, that works out to 3,000 Rand per month. You could do as a debit order, but the lifetime limit is 500,000 Rand per person. So no one should be there yet, but we're getting close. So if you contributed every year, you'd work out it'll take you about 11 or 12 years to be able to reach that 500,000 Rand maximum. So in theory, the earlier you can get this going and get to that 500,000, the more beneficial the tax-free nature of the investment will be. So this investment is completely tax-free on the growth it earns, whether that's interest or capital gains or dividends, as well as when you withdraw money from the account in the future. You know, it's a great investment vehicle if you've got minor children or if you're just starting to work and you can try and contribute as much as you can to this when you're younger, then it can really have a material benefit for you over the long term. Now, we're just going to talk about endowments and wrappers. So endowments and wrappers are similar vehicles. The only difference is how they're treated on death, but they're treated the same in terms of taxation. So a key thing with an endowment, or what's called a sinking fund wrapper, is that the life insurer or the platform that you invest with, they become the investor from a tax perspective, and they handle and make all payments of taxation to SARS on behalf of the investment. So if you can think of it this way, essentially the investment funds itself from a tax perspective. So when tax needs to be paid, there's a disinvestment from the investment account that pays tax to SARS automatically at that event that triggers the taxation, which would normally be a withdrawal or a portfolio change that would trigger a tax event. So that's different from if you invest in your own hands, if you earn capital gains or interest, etc., and then you have to disclose that in your tax return. So if you invest using an endowment or a wrapper, you don't have to disclose anything that's going on in the wrapper from year to year in your own tax return. So essentially, it pulls that capital out of your personal tax situation. So the tax rates is it's taxed at a flat 30% tax rate. So that's a good tax rate if you think about the marginal tax rates we looked at earlier. I mean, you only have to earn around 400,000 Rand a year to be a 31% marginal taxpayer. So an endowment is 30% across the board. For instance, offshore wrappers don't declare interest. So the only tax you pay in an offshore wrapper is capital gains tax of 12%. So that's a really tax efficient rate for growth, income, dividends, and you're only paying 12%. That's a good tax efficient rate for investments. In South Africa, dividends withholdings tax is always going to be 20% because a company pays dividends withholding tax when they issue the dividend. And as I said earlier, the tax is handled by the insurer. So you don't get issued with tax certificates. All you get is when you withdraw the money, you get the after-tax lump sum paid to your bank account. And all the tax affairs that would have been handled already. So in our view, wrappers and endowments are very useful, especially in South Africa at the moment where trusts have been taken on by SARS and trusts have become less and less useful over the last 7 or 8 years. So endowments and wrappers are very useful, and we've got a good real world scenario we'll show later of how you can integrate this into your tax planning. Then finally, retirement funds. I think everybody in South Africa, most people do contribute to a retirement fund, and I think you have an idea of the tax benefits around that. But I think it's quite good to absorb and understand exactly how tax efficient these vehicles are. So first and foremost, when you invest into a retirement fund, whether that's a pension fund, a provident fund, or a retirement annuity, all of that growth is tax-free. So if you have a working career of 30 or 40 years and you're contributing all throughout that time and that money is growing tax-free, that's got a massive compounding effect on that end investment value that you have when you do get to retirement. If you think about the example we just showed, where 10% annualized return was coming out at either 7% net after tax all the way up to 8.8%, that rolling tax does reduce your return over time. So if you can have tax-free growth, all the better. And then in addition to that, all the contributions you make to the fund are tax deductible. So we'll talk a little bit later about what happens if you do excess contributions. But for now, when you contribute to a retirement annuity or a pension fund, you're allowed to deduct either 27.5% of your taxable income. You can deduct from your taxable income if you make a contribution to a fund, and it's limited to a maximum of 350,000 Rand per tax year. So that works out to, if you earn just under 1.3 million Rand in taxable income per year, then you'd be at that 350,000 Rand cap. So not only are you growing the money tax efficiently, but you're getting a deduction on your other sources of income, such as salaries, bonuses, pensions, etc., while you are contributing to the funds. Okay, and then we just want to talk about offshore. I know we did cover this in our offshore webinar we did last year, but we still think this is a really important area to understand. So understanding the difference between having indirect offshore investments, which are essentially rand-based or rand-denominated offshore investments. So what are those? Those are, if you've ever invested into feeder funds in South Africa, which are unit trust funds, then you invest in rands, and that unit trust manager goes and buys offshore funds or a mix of offshore assets offshore in that rand fund. But you as the investor, you're investing in rand, all your growth is shown in rand, and ultimately you are taxed on that rand growth over the time of the investment, which includes any exchange rate weakness in the rand. So as the rand has weakened over the developed world currencies over the last 10, 15 years, that weakness has been included in your performance if you've been invested into a feeder fund or what's also called an asset swap fund. So here you're essentially not taking money directly offshore. You're using the institution's exchange control capacity to invest that money offshore for you, either through a unit trust or through an asset swap facility. Those investments, because they're in rands and they're South African investments, that can be paid out to your SA bank account. So that's a good way to invest offshore in terms of it's quite easy, but it's not the most tax efficient way to invest offshore. If you look at the right-hand side, if you have to take your money directly offshore, now you would be doing it using your own exchange control. So you would be applying to take money offshore, or you could take your 1 million rand per year that you can do without any tax clearance. And then you would be buying unit trust funds or shares, ETFs, whatever you would like, directly offshore outside of South Africa. We are big believers in using wrappers when you invest offshore. We'll talk about the example for wrappers just now. And then you are only taxed on your foreign currency growth. So if you invest $1 million and your investment 3 years later is $1.1 million, and the rand has weakened 50% in those 3 years, the rand weakness, the element of the rand weakness is not in your capital gains calculation, because it's really your dollar growth. In that example, $100,000, that's what you pay your capital gains tax on. So the formula for calculating capital gains is a lot more friendly when you do it directly offshore. And obviously, in addition, if you're using a wrapper offshore, the tax rate is at 12% instead of 18%. So we just got a practical example for this. And here we've actually used, quite a common fund. We've used the Orbis Balance Fund. So on the left-hand side, we've got the Rand version, which is called the Allan Gray Orbis Feeder Fund or Balanced Feeder Fund. And on the right-hand side, we're using the direct Orbis Balanced Fund in dollars. So if you made an investment 10 years ago, you invested 10 million Rand. Back then, the exchange rate was 12.25 to the US dollar. As you can see, if you invested in the Rand version, you would have invested 10 million Rand. Over 10 years, your growth would have been 21.4 million Rand, and your end value would be 31.4 million Rand. The full growth would be included in your taxable, or would be included as a capital gain or considered a capital gain. 40% of that is included in your taxable income. And that results in a capital gains tax that would be due of 3.84 million Rand. So it's quite a sizable taxation that you would have to pay when you ultimately sold that investment at the end. So that taxation reduces your actual outcome from 31.4 million to 27.5 million Rand as your after-tax outcome. Now, if you did the same investment but did it directly offshore, buying the dollar-based fund, your starting value would be in dollars, $816,000. Your gain in dollars would have been around $950,000, and your closing value would be $1.76 million. So in rands, when you take the dollar gain and you convert it to rands at today's exchange rate, or we've used the end of May's exchange rate of 17.99, the capital gain now is 17 million Rand, as opposed to 21.4 million Rand. So you can see there's a large difference in the amount of your profit that is considered a capital gain. And you times that by the 40% inclusion rate, And now, because what we're saying is you've done this correctly and you've invested in an offshore wrapper where you are not paying tax out of your pocket, the investment is going to pay tax on its own behalf. Now the CGT rate is 12% and not 18%. So the actual capital gains tax in this scenario in the wrapper would be 2 million rand as opposed to 3.84 million rand. So the outcome and the difference in this investments is just over 2.1 million rand, which we believe is a sizable difference in outcome considering it's essentially the same investment, it's just made in different currencies. So that's just a practical example on the offshore side. Okay, now we're going to go into some real world scenarios. I think we've got 4 different scenarios to go through. In this scenario, we've got a gentleman, we've said a 70-year-old, he's got 20 million rand portfolio. And he's split that portfolio between a living annuity and he's also invested, he's got some savings. So in the living annuity, he's got 10 million rand. He's drawing an annual annuity income of 720,000 rand. As we know, because it's an annuity, pay as you earn is paid directly to SARS. So he gets an after-tax income. And the key thing is that he's decided to invest this living annuity into balanced funds. So his understanding is, you know, you've got to grow your retirement money properly. So he wants to take on a little bit of investment risk and target a good return on this investment. So he's decided to invest in balanced funds in the living annuity. On the other side, now he's got his cash savings that he's built up over time. And he said, okay, I've got some risk in my living annuity. I don't want to have any market exposure in my savings. So I'm just going to go to the bank and I'm putting this in a fixed deposit that I'm going to keep rolling over in terms of my savings. So now he's got 10 million rand in the fixed deposit, and that's earning him around 900,000 rand a year in interest. So because it's interest income, the bank isn't paying tax on your behalf on that income. You're receiving that income. You have to declare that income in your tax return when you file your tax returns with SARS. So this gentleman, he would be a provisional taxpayer because that interest income would push him into provisional tax, which means he would do 3 tax returns per year. So he would have to estimate what his income is and he would have to pay into SARS. So in this example, when he does his tax return, we've calculated he would have to pay in over the year around 369,000 rand for that interest income that he's earned. The reason for that is that the living annuity provider is taxing him on his income at 720,000 rands worth of income based on the tax tables. The living annuity provider is not factoring in the other interest income that he has. Now, the other interest income is taking his taxable income from 720,000 rand all the way up to 1.6 million rand. So it's pushing up his marginal tax rate and his overall tax on all of the income, not just the interest income earned. So that's why he's having to pay in such a substantial amount, because now he's moved up tax brackets by earning this interest income in his own hands. And we've worked out what the tax effect of the 900,000 rand is actually an average 41% rate. Or marginal 41% rate that now he's paying on the 900,000. So not a very tax efficient solution. Now, if we had to do the same sort of investment with the same assumptions and just change a few key elements, we can see how we can reduce the taxation in this scenario. So the living annuity is exactly the same except for one thing. He's changed the investment asset allocation. So instead of investing into balanced funds, let's say we discuss with him and we say, okay, we understand you want some income generating lower risk investments and you want some more balanced investments that have some stock market exposure and bonds, etc. So why don't you do it the other way around? Because living annuities, you can earn what you want and it's tax exempt. You only pay tax on what you withdraw. Let's rather put the living annuity in income funds. Those income funds can earn interest income similar to a fixed deposit, and you only pay tax on what you actually draw out, not on what you earn. And then on the other side, let's move your money from your fixed deposit and let's put it in a local wrapper, also known as a sinking fund or an endowment. So we put the money in a wrapper, and here you can also earn 9%, But the key thing now is we're saying invest the wrapper into balance funds, because balance funds are more tax efficient than if you had to earn solely interest income. As you can see, the tax paid in the wrapper over 1 year of earnings, we estimate would be around 145,000 Rand. So it's a lot lower than the 369,000 Rand in the previous slide. And then the big outcome for him when he goes and files his tax returns, because all of the returns that are earned in the wrapper is funded by the investment itself, he doesn't have to declare anything additional in his tax returns. He's got his living annuity income, and that's it. He could potentially even get a refund from SARS if he's got any medical aid contributions, medical credits, etc. So this gentleman, he now doesn't have to pay anything indirectly to SARS out of his own pocket. And all we've done is change two key things. We've changed the asset allocation and the different investments. What we could call asset location is being smart about where you put different assets across your different vehicles. And the fact that we've changed the fixed deposit to a wrapper. Now he doesn't have to disclose that income in his own return, and he doesn't have to pay any additional tax at the end of the tax year or when he does his provisional returns. So all in all, a much more tax efficient case study for the same sort of portfolio structure. And the last real world scenario is here we've got a businesswoman. So we're going to talk about Section 10C. And Section 10C refers to excess contributions. Now, what are excess contributions? Excess contributions is, as we discussed earlier, you're allowed to claim a certain amount of your contributions to a retirement fund back as a tax deduction from SARS in the year that you make those contributions. So you can do 27.5% up to 350,000 Rand. Now, what happens is it doesn't mean you're limited to contributing only that amount. You can contribute above that. You can contribute, much more than that. The key thing is that in those tax years, you can only limit it to claim 350,000 Rand as a maximum deduction in that year. But what's called the excess contributions, which is over and above that, that rolls over. So the excess contributions roll over. You can continue to claim them in subsequent tax years. But then when you get to retirement and you actually retire from your fund, if you've got excess contributions, or what's also called disallowed contributions, which are contributions you've made surplus to what you've claimed as a tax deduction, you get quite a bit of future tax relief from those excess contributions. And we'll show that in an example now. So here we've got a businesswoman. She sells her company at the age of 58, and she receives an after-tax capital payment of 20 million Rand. So this is a nice scenario. Now she's in early retirement. She's got 20 million Rand cash, and she's got a blank slate. She can invest how she wants to because she's got cash that's ready to go into different vehicles as we design for her. So she decides to contribute 10 million Rand of her lump sum into a retirement annuity. In that year of contribution, 350,000 Rand is claimed as a tax deduction, and that reduces her taxable income in that year. However, the remaining 9.65 million Rand is recorded on her tax return as excess contributions. And the following year, she decides to retire from the retirement annuity and convert it to a living annuity. Now, living annuity is an investment that gives you an income. It's a post-retirement investment. Because she hadn't claimed the tax deductions on that 9.65 million, that portion of capital that's recorded by SARS goes into the living annuity as its own category. And as she starts to draw on income from her annuity, and now she's retired and living off of the investment, the amount that is drawn from those excess contributions pot is considered tax-free or tax-exempt. So in this case, where you've put a large lump sum into an annuity and you've only taken a tax deduction on a small amount, the bulk of the income she draws from the investment will be tax-free. So how it works in practice is you will pay tax to SARS as normal PAYE, but then you would get a tax refund from SARS when you do your tax return. So for the right scenario, This is a very tax efficient vehicle. You've got tax-free income from the proportion of what's considered excess contributions in the fund, as well as tax-free growth, because remember, living annuities are completely tax exempt in growth. So we like using this, particularly if you use it in collaboration with other investment vehicles. We think that the Section 10C is a very powerful tax planning tool. Okay, and our final topic before we get through to just our conclusion and questions is immigration and tax. So I think the key thing is that the terminology financial immigration is still being used. SARS did away with financial immigration in March 2021. So financial immigration no longer exists. SARS has said you don't, when they're trying to stop South Africans who are leaving the country just to go work overseas, having to cut all tax ties with South Africa and formally immigrate financially. So what SARS is saying is they're going to a tax residency-based system. So when you leave the country, you break tax residency with South Africa in one of two ways. The first way is you decide that you're no longer ordinarily resident in South Africa. So what that is you decide that South Africa is no longer your home. Your South Africa is not your main home anymore. You don't consider the country that this is the place you will return back to one day, and you feel that the new country you live in is your new long-term home. On the other side, if you just go and work overseas and you don't decide that South Africa is no longer your home, you're not sure if you might return, but you go and you work overseas and you live in a different country for long enough, that country's double tax agreement is going to swallow you up to become tax resident of that country. So it's not so much you saying to South Africa, I'm not going to consider you my home anymore, but essentially now you've lived in another country and worked in another country long enough. Normally, if you're in a country for longer than 6 months, and then that country's tax rules would say, oh, we notice you've been here and working here for a long time. You're now tax resident of our country, and you're going to pay tax in our country on your income. So that's how it works now. It's really about tax residency and managing your tax residency. Now, what is the tax effects? What are the tax effects when you cease to be an SA tax resident? The first one is your worldwide income is no longer taxed in SA. Because you're no longer SA tax resident, you will only pay tax on your SA sourced income. You must formally notify SARS of your change. So either way that you've no longer been a tax resident, you must inform SARS of that. You can do that when you do your tax return, or you can fill in what's called a RAV01 application with SARS. You essentially go on their system and you change your country of tax residence to another country, and you will have to give them a whole lot of long list of supporting documents such as visas, proof of residence, proof of income, etc. for your new country of residence. And you may still need to submit a tax return in South Africa if you earn income in South Africa. So I think there's a lot of people who are earning annuity income in South Africa when they've already left the country. There's a lot of beneficiaries of trust. If you've got children or family members that live overseas but still earn trust income and they're not doing their tax returns in South Africa, SARS is going after those individuals and penalizing them because they're saying you haven't filed 3 years of tax returns, plus we're doing X% penalties on the amount of tax you owe us. So just if you've got any friends or family members that do earn SA income but aren't doing tax returns and they live overseas, just remind them to do the tax returns, whether you do an auto submission or something simple, just to make sure they don't get penalized. Now, what is the big tax effect when you leave the country and you do get claimed to have had your tax residency changed? Is what's called now they're calling exit tax. So an exit tax is really the deemed disposal of all of your worldwide assets. And what is the tax that applies to that sale of everything? It's capital gains tax. So now what SARS is saying, if you leave the country and you stop being a tax resident, we are seeing you as having sold everything you own the day before your tax residency changed. And we are going to charge you capital gains tax as if that were the case. Now, in most cases, you haven't actually sold all of your assets. You still own those assets or most of them. But now SARS is going to charge you a tax bill as if you've sold everything. So what's included in that is shares, unit trusts, crypto investments, offshore assets, and that tax bill is due quite soon. So you do a final tax bill as SA tax or tax return as SA tax resident, and you have to pay that capital gains tax quite quickly. So that's a problem because not everyone has money for that CGT, and we'll go through that now on the next slide. So this is a big one, is what is excluded from SA tax, or from exit tax. Your SA and movable property is excluded. So any fixed property you have in South Africa, land, buildings, homes, and it includes if you're a shareholder of a company that owns properties, that's excluded. You don't have to have a deemed disposal as being seen from a tax perspective on those. Your retirement funds, as we know, you can't just take those out the second you leave the country. The new process there is after you cease to be an SA tax resident, you must wait 3 years and then you can apply to withdraw from your funds. That withdrawal is a taxable withdrawal, and that tax is up to 36% on that withdrawal. And the bottom one is the big one, South African owned insurance policies, which includes investment policies such as endowments, sinking funds, and wrappers. So why is that so important? If you're going to invest offshore and you know you're likely to cease tax immigration or cease tax residency in the future, or you possibly will cease tax residency in the future, it's better to invest with an SA-owned insurance policy with an SA-owned platform, even though the platform can sit overseas. For instance, we use the Isle of Man and Guernsey overseas. And the reason that's better is then when you leave the country one day, you're not being seen as selling that whole investment the day you leave the country. So if you go and invest directly with a foreign bank, not only do you create potential state issues because now you've got an estate in that foreign jurisdiction, but when you leave South Africa, SARS is going to charge you capital gains taxes if you sold that foreign investment. So SA-owned insurance policies are more friendly around this. You can see, although your underlying assets still sit offshore, they are locally taxed because the wrappers are designed to pay tax to SARS and be compliant with SARS. You don't have to worry about that. And no CGT is triggered when you immigrate, and there's no deemed disposal. So what are some practical examples when immigrating where we see big challenges? And the big thing is having cash to pay the capital gains tax, right? So you've got all these assets, and now SARS is saying we're seeing you as having sold these assets, and you've got to have the cash to pay that capital gains tax, regardless of if you've ever even sold them or not, or actually sold them or not. So number one example is foreign property. If you're planning to move overseas, you potentially buy a holiday home overseas or several homes overseas, and those assets have appreciated in value. Now you decide you're going to live 9 months of the year in Greece, and you break tax residency with South Africa, and SARS says, okay, you owe us tax on all of your assets. You have to pay capital gains tax on those foreign properties. Now, you haven't sold those properties. You probably plan to keep those properties, and you have to come up with the cash to pay tax for those properties. Another example is offshore shares. Like I just mentioned, if you go to one of the big foreign banks, you've got share portfolios or unit trust funds or a combination overseas, and you go and you now break tax residency. SARS is going to charge you capital gains tax on those shares. And a major one, if you are a founder or big shareholder, majority shareholder in an SA private company, you now decide to live somewhere else and the company keeps operating. So you're just going to live more than 6 months of the year elsewhere. You're still going to keep your company. You're still going to keep certain assets in South Africa, but you break tax residency. SARS is going to tell you that from a tax perspective, you're seen as having sold this company. Now, you probably haven't sold the business. You haven't realized the capital. So, I mean, an example, if you've got a business that's got 100 million rand valuation, the base cost is 100 rand. Now you've got to pay capital gains tax on 100 million rand. That capital gains tax is close to 18 million rand. That's a big, big problem. So we're seeing this as quite a common issue for private company owners or shareholders is you go and live overseas. You don't stop operating the business. You don't sell the business, and SARS is going to come after you for a large payday for that. So that's an issue. You have to plan for liquidity around that. Okay, so finally, before I hand back to Nick, just a little bit on our process. So ordinarily we do this, follow this workflow when we speak with new prospective clients or existing clients of ours. Initially, it's all about understanding your needs. I know we've spoken quite a bit about your different buckets you have in your investments, your retirement wealth, your discretionary wealth and your savings in South Africa, as well as your direct offshore money, understanding how they all are structured to complement each other and how you can get everything as tax efficient as possible. So that initial engagement is really to talk through your needs and understand your situation. What we do is we build out a comprehensive financial plan for you. We do a health assessment of all your spending and do different scenarios, and you get a report for that. We also do an analysis of your investments, understand your risk and your fees. And finally, we would do a tailored proposal, which would cover both the portfolio recommendations and obviously the most optimal tax structure for your wealth. So that process we do, that's a complimentary process. We don't charge any consulting fees for that. And then if you do invest with us, obviously there will be ongoing advisory fees that would apply. So just in conclusion, tax efficiency drives real returns. So be aware of what your after-tax returns are of your various assets, whether it's a rental property, a fixed deposit, and a retirement fund. It's not difficult to calculate how much you're actually making after tax and making sure you're actually growing your money above inflation. Plan proactively, not reactively. If you can have foresight in thinking about how your life might pan out, where you might live, how much money you might need to spend, the earlier you can plan, the better it is. Blend your investment strategies intelligently. So we showed quite a simple scenario earlier between the living annuity and the wrapper. We can do it a lot more complex than that using multiple vehicles, including trusts, etc. So having everything talk to each other correctly is very important. Know the impact of life events. If you are planning to retire soon, if you are a business owner that's going to have to sell the business one day, if you are someone who's a founder of a trust and needs to distribute those assets someday, if you are planning to leave the country and emigrate, the earlier you can plan for it and get your things structured, the better it can be. And then finally, work with independent experts. So at Investonline, we combine independent advice with personal financial and tax planning. So we feel we're very, very strong at this, combining that with the portfolio and market side. So please, our financial planners are available to speak to anyone and map out, your tax plan. So yes, please get in touch with us. Thank you, Nick.
Good, sure. Well done, Stuart. That was a lot that you covered there. And I know there's
a lot to get through.
A lot more detail behind that.
Yeah.
Everyone, thanks for submitting. We've got lots of questions that have been submitted, so I've just gone and handpicked a few of them. And any other questions, please email us, and we're happy to respond to you. Okay, Stuart. So one is you spoke about excess contributions. It was section 10C. The tax-free portion of it. How do we actually realize that? What are the practicalities of realizing that tax-free portion?
Yeah, so that's a good question, Nick. So the 10C section gets recorded with SARS, and essentially there's different ways you can choose to use that. So when you retire, you can take a larger lump sum, and that section 10C portion can be drawn as a lump sum tax-free. So that's one way you could use it, is to take it as part of the lump sum. So your normal retirement tax table, the 10C portion doesn't get taxed as per that table. That can be drawn tax-free. Alternatively, like in my scenario, you can say, I don't want the lump sum. I want to roll this over to an annuity, and I want to draw the income tax-free. So that's the second way you could do it, is not to take it as a lump sum, roll it into the annuity and draw the income tax-free, or at least have a portion of your income tax-free. And then if you actually die with the excess contribution still in place and your beneficiaries decide to cash in your annuity, whatever's the excess contribution can still be drawn by them tax-free. So that excess contribution really does roll over, and there's different areas where it can be used, or different events where that excess contribution can provide a tax benefit.
All right. Thanks, Stuart. Then just tax paid when I retire from a retirement fund. I mean, how much tax do I have to pay?
Yeah, so that's quite a broad question, Nick. I mean, when you retire, there's the two events. There's the once-off lump sum that you choose to take. So that tax table is the 550,000 Rand tax-free, all the way up to then over 1.15 million. It's 36% is the top tax rate. So that tax table does ramp up quite quickly from 0 to 36%. So on the lump sum, you're going to pay that tax between 0 and 36%. And then with the rest of the money that you put into an annuity or a pension, then you're paying tax on the income you draw. So that all depends how much you draw, Nick, because that's taxed as per tax table. So if you're drawing 10,000 Rand a month, that's below the tax threshold, you pay no income. If you're drawing 100,000 Rand a month, then you're going to be at that 41% marginal tax rate. So it all depends on how much you draw from the annuity once you retire.
Okay, all right, thanks. And then one last one, which I think is really important here. So we've spoken about tax and the different planning. How does the tax planning actually bear? Does it have any bearing on my estate planning that I need to do?
Oh, so tax planning and estate planning, our view is you should do it together, at least understand how they work together. If you go and build an estate plan with an attorney and you do your tax planning with someone else completely and the two don't speak to each other, that often doesn't work very well. Often, to be more tax efficient in life could be less tax efficient in death, and vice versa. So you set things up to be tax efficient in death, like trusts, etc. You could have to pay a lot more tax in life. So I know the way we do it, Nick, is we like to have a good balance, make sure everything's reasonable, pay reasonable tax while you're alive, and as little tax as you can when you pass away and have your estate be tax efficient. It should be worked out together, and that's what we try and do.
Okay, thanks. Right, thanks, Stuart. Thanks for answering that. Thanks, everybody. I just want to reiterate in terms of the tax structuring, there's so much saving you can make if you just do it correctly. I must have done some rough calculations. You could probably save somewhere between 1% and 2% of your return annually. You compound that over 20 to 30 years, it can make a significant change to your retirement savings one day. So I'm always amazed at the plans we do, how tax inefficient a lot of people are. And just with a couple of easy, and it can get more complicated tweaks, it can save you quite a bit of money. Then obviously to blend the right investment strategy into that is really important. So yeah, get hold of us if you need any help. Then also I'd just like to refer you to our past webinars. If you haven't seen any of them on our website, with the past ones we've done one on investment markets recently. That was very interesting, talking about Donald Trump and all the tariffs, etc. Our retirement webinar and a separate estate planning webinar as well, one on living annuities and one on offshore. So go to our website and you'll be able to see recordings of those. We should have another live webinar next month, and we'll be in touch. And yeah, if you need any assistance, please email us to get hold of us. Thank you for attending. Cheerio. Bye.
Thank you. Bye-bye.